Okay, let's take a look at a sample transaction of a sale on account between two businesses located in different jurisdictions using different currencies. This is one of it's sort of the basis of a couple of your homework problems. It's a good problem to kind of show some of the journal entries and the accounting that result when companies are doing business across borders. So in this example, we have Mattel, which is a US company that makes toys, selling to Hamleys, which is a UK company that sells toys. So Hamleys is kind of like a Toys R Us type of company. Hamleys is going to buy the toys from Mattel and they're going to turn around and sell them to customers in the UK. That's effectively kind of what's going on here. And let's look at the transaction. The transaction is on January 1st, the actual sale of the goods. And the goods are going to be valued in British pounds, and it's going to be valued at £1,000,000 on January 1st. Now, because the exchange rate at that date is 1.3, and notice it's a direct exchange rate, meaning 1.3 USD to 1 British pound. So we're going to multiply a million times 1.3 to value this transaction in USD at $1,300,000. Okay. I have a whole separate video about that exchange rate math that I just walked through. So please refer to that video if any of that little math that I just walked through is unclear. The key here really is that we have a transaction that is valued in pounds from Hamley's perspective and is being converted into US dollar from Mattel's perspective. And the sale itself is valued in terms of the pounds. So it's 1 million pounds. So on the date of the transaction, Mattel is going to set up a sale for $1,300,000 and then an account receivable also for $1,300,000. But then here's what's going to happen. Here's the wrinkle. On January 30th, 30 days later, this account receivable is going to be paid off. The sale itself, the kind of like original value of the transaction, is still going to be £1,000,000. That hasn't changed. But now the exchange rate has changed. It's now 1.285, which means that Hamleys is only going to pay. And one way to think about this, Hamleys writes out a check for £1,000,000, sends it to Mattel, and it gets converted on Mattel's side to $1,285,000 because that's the exchange rate on that date. And Mattel has a little wrinkle here. They now have a $15,000 differential between the original sale value and the account receivable that was set up for that sale and the actual cash that they're realizing in relation to the sale. Journal entries are going to be super helpful for us understanding kind of the walk of this data, meaning like what's happening transactionally, but then also what do we do with this $15,000 because we need to book it into our financials. So let's take a look at the journal entries. They're all on the screen here. I also have kind of the notes here as to what's happening. Pause along the way if you want to, and kind of like focus and then continue the video. So the basic idea here is this. On the date of sale, which is January 1st, the account receivable is set up along with the sale. And this is, by the way, a principles one concept, right? We're going to debit account receivable for $1,300,000. We're going to credit sales for the same amount. Then 30 days goes by, and Hamleys is going to settle that receivable, and they're going to send the check to Mattel. They're going to value the check, meaning the cash paid, at £1,000,000. £1,000,000, right? But it's going to get converted into $1,285,000. And here's where Mattel is going to now realize less cash than they originally anticipated on the date of sale. The cash received is going to be $1,285,000, and that's going to be debited. And then, of course, the account receivable will now go down by that amount. Of course, we have now this $15,000 differential between the original sale amount and the amount being realized in cash. And we need to figure out how to book that. We need to account for that. So what we're going to do is we're going to credit account receivable for the remaining $15,000 so that we actually total up to $1.3 million for purposes of netting the account receivable back down to zero. And we're going to book a debit to what's called foreign exchange loss. Now, foreign exchange gain or loss, the gain or the loss is going to depend on whether or not cash payment was more or less than what we originally anticipated. In this case, because we're receiving cash of kind of less than what we anticipated, we're going to have a loss. So we're going to have a debit here of $15,000. If the exchange rate moved in a way where we received more than $1,300,000, then we maybe have an exchange gain. Look at these on your own, take your time, and keep in touch with questions. Thanks.